What are your thoughts on lump sum investing versus dollar cost averaging?
Yeah, we get asked this quite often. So, somebody has some money and they want to know, because you never know, is this the right time
Yeah.
to invest, right? I mean, I get that a lot. Is this the best time to invest? And, it's very difficult to tell that. And so maybe one strategy would be that you would take the money and split it up and put it in monthly for a while,
Hmm.
just to kind of mitigate some of the risk of putting it all in up front. Well, there's a great study that Vanguard did based on this, and so let me share the screen here so we can see that. And so what they're showing here is just, hey, I put it all in at the front, and I'm fully invested for 12 months,
Hmm.
my lump sum, right? Versus cost averaging, I'm going to put it in over 3 months, so basically a third, a third, and a third,
Yep.
and now I'm fully invested for 9 months. So first of all, one of the things you notice there right away to me is that you're not fully invested for the full time period. And that can make a difference. The market spends more time going up than down.
Yep.
And so what that means is if you looked at this over a long enough period of time, cost averaging should do worse, in my opinion, just because during that 3 month time period, you weren't fully invested.
Yeah, you're out of the market.
Yeah. And so, and that's sort of backed up by their study. And I know this is a little bit small and such, but I'll describe. So the first circle says 68%. So 68% of the time, a lump sum investing beats dollar cost averaging.
Hmm.
So this is from, what was the time frame on this in total?
I think they went back 1976 to
Okay,
2022.
good. 76 to 22. Okay, perfect. So that takes into account a lot of great markets, actually. And so it's lots of ups and downs in there. 68% of the time, better off just putting a lump sum. And then the next two circles are how each one does versus cash. So cost averaging beats cash 69% of the time, and lump sum beats cash 70% of the time.
Hmm.
That makes sense. So over a 12-month period, for the most part, the market makes more money than a money market.
Yep.
Yeah, on average, not 70% of the time. Is basically is what it's saying. So, all right, but there is one other interesting thing that they put in the study, and what this shows is for each one. And remember that the turquoise blue color is your lump sum, and the gold color is kind of your dollar cost averaging. And what you kind of want to look at there is those tails.
Hmm.
And what the tails show is kind of how far up or down you got on a 12-month basis. And if you look closely, you can see that the tails are smaller on the gold colored bars.
Hmm.
And what that means is there's a little bit less risk to the dollar cost averaging,
Yep.
even for the 100% equity all the way down. And so if that's the main criteria for risk, then it might make some sense, right, for
Hmm.
the dollar cost averaging. So if that's what it takes to get you to invest, it's better than leaving it in the money market,
Yep.
right? And so if the dollar cost averaging makes you more comfortable and you really feel uncertain about what's happening, even though it doesn't win as often, it does have a little bit less risk tail there for that downward tail. And you could make an argument for doing that. Whatever it takes in the end to get somebody comfortable, to get them into the marketplace so that they can, make some returns over the long term and hopefully keep up with inflation is important.
So what would you recommend for someone that's like a, kind of like a moderate risk profile with, some loss aversion? Which strategy
Some
would you?
loss aversion, I would do the lump sum. Yeah, because to me, you just described almost everybody.
Hmm.
Right, almost everybody has some loss aversion. So it's more of that somebody with a heavy loss aversion.
Hmm.
So first of all, be looking towards something more like that 40% equity portfolio instead of the 60 or even
Yep.
lower than that, 20 or what have you. And the dollar cost averaging would not be a bad idea, for that situation also. So, there's that. We run across the spectrum of people's risk tolerance. I mean,
Hmm.
it's really amazing, right? And there's no standard, and that's what's, and age is only a very small factor. I've got very aggressive older people and very conservative younger people. It's much more just so, where you're at in your life, what you've experienced in your life, and those type of things. It's your experiences that are coming to play here. So for somebody that had a heavy risk aversion, yeah, something, 40% or less stock market exposure on a 3-month dollar cost averaging, I have no problem with that.
Mhm.
That makes sense. Yeah, nothing wrong with that.